This video will provide a walkthrough to the solution of exercise 12.6, which focuses on accounting for notes payable. Here's the data for our problem. On January 1st, 2025, Term & Co. issued a $120,000 3-year 0% interest-bearing note to Northlace Limited in exchange for $95,260. At the time, the implicit rate of interest was 8%, and Term & uses the effective interest rate method. We have 4 requirements for this problem. The first is to record the issuance of the bond, then the recognition of interest for the year end on December 31st, 2025. Next, if the implicit rate had not been provided, to provide a calculation of the proof that would determine the implicit rate of 8%, and then finally to prepare an amortization table for Northlace Limited. Let's begin with requirement A and record the issuance of the note from the perspective of Northlace Limited, who is the borrower. The problem tells us that Term & issued a $120,000 note in exchange for $95,260. This simply means that Term & who is the lender, is going to give $95,260,000 to Northlace, who is the borrower, and in 3 years' time, Northlace is going to return $120,000 back to Term & That $95,260 in essence is the present value of the note, and that's the amount that Northlace is going to use to account for the note, and therefore will debit cash and credit the note payable for the same amount. Even though this is a 0% note, there is an implicit rate of interest that would otherwise exist, since the borrower would have to pay 8% in this case to borrow money elsewhere. In addition, if the borrower is borrowing $95,260 and returning $120,000 at the end, that difference implies interest. We actually have enough information provided in the problem to confirm that the $95,260 is indeed the present value of the future cash flows using the implicit rate. So with your calculator from left to right, let's enter 3N, 8IY, 0 PMT because there are no periodic interest payments, 120,000 FV, and then compute PV, and we end up with 95,260. Requirement B asks us to record the interest at December 31st, 2025, which is the company's year end. So we can calculate interest expense as the balance of the note payable times the 8% rate of interest. So $95,260 times 8% is $7,621. We can also use the amortization feature of your calculator. So if you press the second function key and then amort, which is written above the PV key, and for P1, press 1 and then enter, press the down arrow, and for P2, type 1 and press enter. And then if you press the down arrow again, you'll see that there's a balance. Press it again, you'll see PRN equals 7,621, and press the down arrow once more, and you'll see INT equals 7,621. In this case, because the note is a zero interest note, the amounts of the interest and the principal are the same. So we're going to debit interest expense for 7,621 and credit note payable for the same amount. Requirement C asks us to prove the implicit rate if we were not given the 8%. So to do that, we would use our calculator again, and with the time value functions, we'll enter 3N. We'll skip over IY because we're going to calculate that. Then we'll enter 95,260 and press the plus minus button, so we enter that into our calculator as a negative value, press PV. Still 0 PMT, and still 120,000 FV. If you compute IY, you'll end up with 8%, which proves that it works. The last requirement is to prepare an amortization table for Northlace. So we'll start with a balance of $95,260. At the end of December 31st, 2025, so the first year, we're going to take that balance of 95,260 multiplied by 8%. That's 7,621, and that amount is then added to the balance to give us 102,881. Then for 2026, we'll take 8% of that previous ending balance of 102,881. That gives us 111,111. And then for 2027, we'll take that 111,111 times 8% gives us 88,89 in interest, which then gets added to the balance to end up with $120,000. If you want to use the amortization function in your calculator, when we set P1 and P2 both equal to 1, we saw that the PRN principal and the INT interest were 7621. And the balance, BAL, is 102,881. If we go back up and set P1 and P2 both equal to 2, we can see that the balance is 111,111. The interest and principal is 8230. And when we set P1 and P2 to 3, the balance is now 120,000, and the interest and principal are 8889. And that's it. We've completed this problem.